In this video, we are going to unpack the health and performance of a business, and we're going to develop two simple dashboards that we can use in order to describe the levers in a business that are driving performance. First measure that we're going to look at is this measure referred to as RONA, or the return on net assets. And what this is measuring is it is measuring the profit from the operations. We call this operating profit, and it's measuring that number, that amount of profit, against the net assets that are used in the operations. So it's the use of these net assets that drives sales and ultimately drives operating profits. And here we are simply measuring these two against each other. We multiply it by 100, that gives us a percentage, and what we have is the return on net assets. So that number on its own has little meaning unless you can compare it to something else, and we might compare it to last year's performance, or we might compare it to the cost of the capital that we need in order to generate these net assets. And we also want to unpack what are the levers that we can pull in the business in order to drive the return on net assets up. So let's explore that for a moment. So here we have the RONA formula, the operating profit over net assets, and in principle we want our returns here to be greater than our cost of capital, and cost of capital is something that we will cover in more detail at another time. I'm going to do something that might seem a little strange here, in that I'm simply going to take this formula and multiply it by sales over sales, which is of course the same as multiplying by 1, so it has no effect on the formula. But what this does allow us to do, it allows us to swap the denominators, and still that doesn't change the outcome of the formula. So what you could do is you could still cancel out sales over sales, and you'll be back to the same formula. But what's unique about this is that we can look at each of these components that I've highlighted in the red boxes and see if we can, one, recognize the formulas because we've covered them previously, but also extract those components that tell us about the underlying performance. So let's look at this first one, this profit before interest and tax over sales. If we have a look here, we covered this under profitability, and there you can see this operating profit that comes out of the income statement. And here we covered the sales over the net assets that we actually called the activity ratio. So they're both formulas that we've seen before, and when we put these together, we could say that this is made up of profitability from operations multiplied by activity, which is the sales that we generate from the net assets. So what we've done is we've created a very simple dashboard consisting of two items, profitability and activity. Now how that really becomes useful is when you compare year on year companies' profitability and activity, you can see how these are changing and how they are affecting the return on net assets. And we will look at that in more detail in an upcoming video. So that talks to the return on net assets. There's one other ratio that's equally as important, and that's the return on equity. So of course here we are describing how the shareholders' money is performing. How much profit is being generated, profit after tax. So you can see we've dropped from operating profit all the way down to profit after tax, and we are measuring this against the equity in the business. So in principle, we want this return on equity to be greater than the cost of equity, and maybe instead of cost of equity you might suggest the expectation that the shareholders have of the return that they want to get in the business. So of course you want to meet their expectations and perhaps provide them with a higher return. So I've taken this formula and I've said let's multiply it by sales over sales. So that's what I did for RONA. But I've added an extra hoop for us to jump through here. I've added net assets over net assets. So effectively what I've done is I've taken the original formula, I've multiplied it by 1, I've multiplied it by 1 again, and therefore it will have no impact on the ultimate answer. But what it does allow us to do when we swap these denominators around, it allows us to create these different components of the dashboard. So here's the profit after tax over sales. Here's the activity, we've seen that before. And this last one refers to leverage. So let's just be clear that we can find those individual ratios. So back to the income statement. Here we have the profit after tax divided by sales. So we've done that calculation already. We know where to find that one. The next one is activity. This was the same for RONA. This is sales over net assets. We know where to find that one. And then the last one that's being included in the return on equity formula is the leverage. And here we are measuring the total capital over the equity. So when we put those together, we get profitability. This time it's profitability after tax, not from operating profit like last time, or like the RONA calculation. And here's the activity, and there's the leverage. So we're combining three different performance ratios to help describe the return on equity. And the result is we have two dashboards, if you want, or a dashboard containing two different measures. And now we can look at a business using just these two items and their subcomponents. And it's quite incredible what we can learn about a business very quickly when we apply these ratios to a business to try and help understand its performance. And we're going to do that in an upcoming video where we're going to look at All-Star, back to our case study, but we are also going to look into a listed company on the Johannesburg Stock Exchange and apply these ratios to understand their performance. See you in the next video.